Hi, everyone. I'm Jacob Goldman, Vice President of Energy Tax Savers. Today, we're going to talk about the changes to EPAct 179D that go into effect for projects placed in service in 2023. So please note, we're not really going to be talking about projects. We're right now in our offices, we're working on projects that were completed in 2022 to get them the tax savings to put on their upcoming tax returns that they have to file. This is not a conversation about that tax year, the 2022 tax year. This is about all the changes that are in effect for projects that will be completed in 2023 and then put on tax returns when you file a year from now in 2024. So that's where the direction of this presentation is going to go. We're going to talk about an overview of 179D, the changes themselves, where they're going to focus on prevailing wage and apprenticeship guidelines, changes to the commercial building 179D opportunity, specifically for commercial buildings. Then we're going to talk about the ASHRAE standards. And if we have time at the end, we'll talk about some of the new alternative energy tax credits that can work in conjunction with 179D. Those were created by the Inflation Reduction Act. The Inflation Reduction Act changed 179D for 2023 going forward, but it also created a whole bunch of alternative energy tax credits, and we'll touch upon those as well. If anybody has any questions, post them in the chat. Those are questions about content. If you have questions about logging in or you can't hear or things like that, I'm not 100% sure we're going to be able to help you. But if you do have those type questions, you should shoot an email down here. I have people looking at my email at jacob.goldman@energytaxsavers.com. So if you have computer type questions, function type questions, shoot an email. If you have content questions, put it in the chat, and I'll pause every a few slides and review those chat questions and then answer them right then and there. So 179D is a tax deduction. It's available for projects doing lighting, doing HVAC, and doing envelope. So it's not for projects doing like structural elements of the building. It's projects that help with energy efficiency. So that we're talking about lighting, HVAC, and envelope. The deduction level depends on how efficient your building is. It is available for both new construction and retrofits. And for commercial building owners, if they did a project in one of those three areas and they did not get a 179D tax deduction when they did their project, you can actually go back all the way to 1/1/2006 and still get that tax deduction for those past projects. So anything all the way back to 1/1/2006 is still available as a tax deduction if you didn't take it back then when you finished the project. One of the more unique elements of the tax incentive is for designers. So for designers, and when I say designers, I'm talking about architects, engineers, ESCOs, design and build firms, system designers, those doing the technical specifications for the project. Those design firms can get this tax deduction for projects that they design that are tax exempt or government. So in the past, it was just government. In the future, in 2023 and beyond, it's for tax exempt and government buildings. So designers, unlike commercial building owners, cannot go back all the way to 1/1/2006. They can only go back 3 years, and that's the amendment window. So you can go back 3 years in the amendment window to get that. So what are the big changes that the Inflation Reduction Act came out with? The Inflation Reduction Act came out in August, and they made a number of changes. But those changes only come in effect starting at the beginning of this year, 2023. So they came into effect as of 1/1/2023. The biggest one was for that design community. So designers before 1/1/23 projects could only get the deduction for designing government buildings. Now they can get it for not-for-profits, instrumentalities, and Indian tribal government projects. They are the only party that can get that tax deduction. There is no mechanism to sell the deduction, transfer the deduction. There's no mechanism to do that. The only party on government buildings, not-for-profit, instrumentalities, and Indian tribal governments, the only party that can get that deduction is the designer. Now, that doesn't mean it's one designer. It can be split amongst a team. We've seen projects where the architect and engineer split the deduction. We've seen up to like a 4-way split or even a 5-way split between different parties that were involved in the design process. There's some new deduction tax levels. So you used to be able to get 60 cents, 60 cents, 60 cents up to $1.80. That actually has dropped. So now the deduction is between 50 cents and $1. And under certain circumstances, if you meet the prevailing wage and apprenticeship requirements, and you have to meet both, that 50 cents gets multiplied by 5, that $1 gets multiplied by 5. So now the new deduction level, if you meet the prevailing wage requirements, is $2.50 to $5. If you don't meet prevailing wage and apprenticeship, it's 50 cents to $1. If you do meet it, it's $2.50 to $5. The overall building energy efficiency must be 25% improvement over a standard, up to a 50% improvement. So 25% gets you the low end, 50% gets you the high end. And then if you're anywhere in between, you're in between. Now, before 2023 projects placed in service before 2023, you could get a 60-cent deduction for lighting only. You can get another 60 cents for HVAC only, another 60 cents for envelope only. That is no longer the case. That is a major change here. It's more holistic. It's what's the energy use of the entire building after your project is done, including pre-existing equipment. And that has to show 25% improvement over the standard, up to a 50% improvement. There is no individual deductions anymore. So for projects placed in service in 2023, there are no longer individual deductions for lighting, individual for HVAC, individual for envelope. It's more holistic. It's the overall energy use of the building, and that's what you need the 25 to 50% range for. There are now 2 methods for taking the deduction. You have the modeling method, which is your building has to be an ASHRAE building, ASHRAE 90.1. The new method is only for retrofits. So if you're doing a retrofit, you can use the modeling method, method 1, or you can use what's called energy use intensity. You have to show a 25% improvement up to a 50% improvement in energy use intensity. For those that are familiar with Energy Star's Portfolio Manager, it's the concepts that are in Portfolio Manager about energy use intensity. You take your energy use before the project, you take your energy use after the project, you compare the two. If you're 25% better, you get the minimum deduction. If you're 50% better, you get the maximum deduction. And one of the things that we're really excited about is it used to be in the old 179D, you can only take a tax deduction once for the lifetime of a building. Now, every 3 years for a commercial building, the deduction resets. So you can take another deduction for a new project every 3 years for commercial, every 4 years for government and not-for-profit. And that says government here. It really should say government and not-for-profit and Indian tribal, for example. It should say all these categories that are up here, should say down here as well. So I'm going to pause for a second. I see there's a number of chat questions. I'm just going to pause and see if I can answer any of these. What certification does one need to be an engineering third-party reviewer? So that would be a professional engineer. You need to be a PE. But licensed contractors, if you're a licensed contractor in the jurisdiction, you can also be a certifier. What's an instrumentality? The only instrumentality I'm aware of is Penn State, and Penn State claimed that they were an instrumentality and therefore were not a government building. And so we helped lobby Congress to add instrumentalities. So places like Penn State that thought they were instrumentalities. Otherwise, I think you're going to have to look that up on the internet. Instrumentality question again, good question. Will we get a copy of these presentations? Need to know how much notes to take. Good question. If any of you shoot me an email at jacob.goldman@energytaxsavers.com. It's on almost every slide. Asking for the slides, I'll be glad to send you a copy of the slides. So don't hesitate to shoot me an email for that. Does the municipality or not-for-profit need to be affirmatively involved in the process, or can the designer apply if they can show the work was done? They definitely need to be involved. There will be a form that they're going to have to sign. Oftentimes that form has under penalties of perjury at the end of it. And they will need to sign off saying that you in fact are the designer, and that some company down the street is not the designer. If you are doing multiple measures, you all have to occur in the same calendar year. So they don't, but if you do a lighting project, we have to model the building as it is after your lighting project. So that would be the new lighting plus the pre-existing HVAC plus the pre-existing envelope. And that would have to show a 25% improvement over a reference building completely, or a 25% improvement on the EUI scale. Then if you did another project in 2024, it depends on what your deduction is left. Once again, it only resets every 4 years. So if you took the full deduction with your lighting project, you wouldn't be able to get this deduction again for 4 years for government projects and 3 years for commercial. I'm gonna move on because these questions they're getting long, and maybe we'll be able to handle that on another run. So what's the deduction level? If you have a 100,000 square foot building, you could get a $250,000 tax deduction. You could get up to a $500,000 tax deduction. These are big numbers now. They used to be a lot smaller. You know, it used to max out, you know, when they changed the amount for inflation, you could max out at $188,000. Now you can get $500,000 for that. Now you can't take more than the project cost. So if your project only costs $40,000, you can't generate a deduction of $500,000. You can only take up to the cost of the project. You convert that $100,000 project to a government building, for example, like a middle school. Sometimes are 100,000 square feet. The designer of that project can get a $500,000 tax deduction. So very beneficial for designers of government, designers of not-for-profits, designers of tribal land buildings. So what is the categories of tax exempt? It's government buildings. It's all government buildings. So on the federal side, offices, military bases, courthouses, post office. On the state side, you know, transportation facilities, prisons, by the way, prisons are eligible as well. State universities, a big category for us. County, city, town, village level, you know, K through 12 public schools. We do a lot of K through 12 public schools. But, you know, town halls, police stations, fire stations, libraries, all those, the designer gets the benefit. Now in 2023, they open it up to not-for-profits. We're talking about, you know, 50% of the hospitals in our country are not-for-profit. All those religious institutions, private schools, private universities. So the designer will get the benefit for those, just simply designing energy efficiently. And then on tribal government, they have police, fire, community centers, they have casinos. You know, designers of those projects can get the benefit for those. So let's talk about commercial buildings, and this is important. You know, all commercial buildings that do an energy efficiency project qualify, but sometimes there's other ways to qualify for these deductions that doesn't involve energy simulation modeling. And so we should talk about that. So what is 179D? It is a tax deduction in lieu of depreciation. So you have this asset, you know, a piece of HVAC equipment. Normally you have to depreciate that over time. 179D allows you to expense it up to that dollar amount, that $2.50 to $5 or 50 cents to $1, depending on if you had prevailing wage or not. So what's the value of this? The value is moving that property from a depreciation to an immediate tax deduction. But there are some other ways to move things that are normally depreciated to immediate. And if you can use those ways, those are preferable over using 179D because there's so much work involved to do 179D, where these other ones don't really involve that much work. So commercial projects, once again, are eligible for all projects placed in service between 1/1/2006 and the present. Commercial building owners can go back. They can get that tax deduction all the way back to 1/1/2006, as I mentioned before. It works perfectly for commercial new construction and all residential greater than 3 stories. That's the sweet spot, is commercial new construction and all residential greater than 3 stories. Now, most commercial non-residential buildings that are doing retrofits, they do not need 179D. I want to repeat that. Most commercial non-residential building retrofits don't need 179D. So for those of you on the call that are in the lighting business and all you do is retrofits on commercial buildings, you do not need 179D. There's no, you can't double dip. There's better ways to deduct the cost of a lighting project on a retrofit of a commercial building, and there's no need for 179D. The Tax Cut and Jobs Act of 2017 allowed for immediate tax deduction and write-off on many types of building improvements. What it is, and we're not going to go into this in this presentation, but you can go off the keywords here, but it's a combination of using what's called qualified improvement property. It uses bonus depreciation. It uses what's called the repair regs. It even uses something that's called Section 179. Now, please note, Section 179 is a completely different section than Section 179D. Completely different section. But using these 4 things, most commercial building owners doing retrofits do not need 179D. There's no need for it because they can use these other things to accelerate the depreciation. Once again, residential buildings, note up here, it says non-residential. Residential buildings do not get these Tax Cut and Job Act benefits, and new construction do not get these Tax Cut and Job Act benefits. Only non-residential commercial retrofits. That's the one category that if you do a project in that category, a retrofit, you probably shouldn't be using 179D. You're doing new construction, 179D is great. Doing any sort of residential, 179D is great. But if you're doing just a retrofit on non-residential, there's other ways and you don't really need 179D. So some important dates. So this was great news that we received in December. The standard is going to be ASHRAE 90.1 2007 all the way out to 12/31/2026. Any project placed in service before 12/31/2026 is going to be compared to ASHRAE 90.1 2007. After 2026, it starts getting compared to ASHRAE 90.1 2019. So for the next several years, we get to compare to ASHRAE 2007, which is very beneficial because LED lighting was not really in ASHRAE 2007. It was still incandescent lighting that's in 2007. So if you put in LEDs, you're beating 2007 quite nicely, at least in the lighting area. Another date that you want to know about is 1/29/2023. That's when, if you start a project after that date, you have to meet the prevailing wage and apprenticeship requirements. If you've started your project before that date, you're grandfathered in and you get $250 to $5 for any project started before that date. Any project after that date, to get the $250 to $5, you have to meet the prevailing wage and apprenticeship requirements. So projects with construction starting before 1/29 are exempt from these requirements and can still get the $250 to $5. Projects started after 1/29, you have to meet the prevailing wage and apprenticeship requirements. So that asks the question, how do you define beginning of construction? Well, there's 2 methods, and they're an or. You can meet either one of these tests. So the first test is what we'll call the 5% safe harbor with continuity requirement. So what that means is you have to have expended at least 5% of the final project cost of the project. So this sometimes is difficult. We had this when on another type of tax incentive where the project went over budget and they put exactly 5% of the budget in the beginning, but the project went over budget. So that 5% turned into 4.5%. In which case they did not meet the 5% safe harbor. You need to spend 5% of the final cost of the project. Which means you probably should, for safety purposes, you probably should spend 7, 8, 9, 10% before 129 to lock in these higher deduction levels. But there's also a continuity requirement, which means the project has to be continuously worked on from the beginning of construction. There can't be any pauses. There's no gimmicks here. You can't say, oh, I'll send a check for 7% of the project cost, and then we'll start everything up in this summer. You have to show continuity that the project was progressing the whole time after you meet your safe harbor. An alternative to that is the physical work test. And that also needs to meet the continuity requirement. And that has to show significant physical work happening at the location. Now, what activities are not counted as physical work? Those are what's called preliminary activities. So if you're just planning or designing, securing financing, exploring, researching, obtaining permits, licensing, conducting surveys, environmental engineering studies, or even clearing the site, those do not qualify as physical work and meeting the physical work test. Those are considered preliminary activities. So you have to be beyond doing work beyond clearing the site in order to meet the physical work test. You don't have to meet the 5% safe harbor because it's an alternative to that, but you have to be doing physical work that happens after the clearing the site section. And those are the two ways that you can show that you started construction, and you're going to want to do that before, we only have, 10 days left to start these projects if you want to avoid having to meet the prevailing wage and apprenticeship requirement. I'm going to pause for a second for these questions. Do religion-based schools typically qualify? Yes. Starting in 2023, projects placed in service in 2023 or beyond in a religious-based school, the designer gets the benefit for that tax deduction. And this next one, I believe we're going to answer on an upcoming slide. And this question here, I will get back. It's just too long to read in this type of venue. So prevailing wage requirements. So how do you know what the prevailing wage in your location is? So the Department of Labor created a website. It's www.sam.gov. And please note, if you want these slides, jacob.goldman@energytaxsavers.com, just shoot me an email, request the slides, and we'll get you these slides. That way you can have all these web addresses that I'm giving you. So you go to www.sam.gov, you put in your location, you put in the type of project, and it'll tell you the prevailing wage for all the different categories. Now, some locations and some categories are not not listed on this website. So if you need what's called a wage determination, if your category or your location doesn't have a prevailing wage listed, you can then send an email to IRA prevailing wage at dol.gov and ask them for a wage determination. When you ask them for a wage determination, you have to include these elements: the type of facility, the facility location, your proposed labor classification, your proposed prevailing wage rate. And by the way, you should probably look at neighboring counties or things like that, and then give your argument for why your number is a good number. A description of the job and its duties, and then obviously any more rationale for your proposed classification. So you need to give all that information in your email to IRA prevailing wage at departmentoflabor.gov, and then they will send you back a wage determination for the items that don't have a wage determination at the www.sam.gov website. To show that you meet the prevailing wage requirement, so now let's say your project is done and you want to prove out that you meet it, you need records for your employees, installing employees that did the install, contractors that did the install, subcontractors did the install. Anybody involved in the project installing it, you need records to prove out that you meet these prevailing wage. So you need to identify what the applicable wage was for each of those employees. The laborers and mechanics who perform construction, you need a list of who they are. You need to classify the work they performed. You have to define them as an apprentice or a journeyman. You need to show their hours, the hours worked in each classification, and then the wage rates paid, what you paid for their work and their fringe benefits. You need all that information. And you'll see on the next slide, not only do you need the hours worked in each classification, you need it on a daily basis, because there's another requirement that we're going to show you on the next page that calculates the apprentice hours to the journey workers hours. You need that ratio on a daily basis, and you need to pass that ratio on a daily basis. So apprenticeship, so the only ones that are really relevant here is if you started your project after 1/29/23, in 2023, 12.5% of your total labor hours has to be apprentices. And then if you start your project after the end of this year, 15% of your total labor hours has to be apprentices. If your project has 4 or more workers, at least one of them is required to be an apprentice. And you must meet the apprentice to journey worker ratio on a daily basis. And those ratios are governed by the registered apprenticeship program. And that's where you have to get your apprentices from the registered apprenticeship program. They will tell you what the apprentice to journey worker requirement is. Now, they did put a good faith effort exception in. It's not well defined, but if you are having difficulty getting an apprentice, you have to show that you requested a qualified apprentice from a registered apprenticeship program in accordance, and here's where it gets weird, accordance with the usual and customary business practices for registered apprenticeship programs in a particular industry. So I'm hoping that means you requested it by email. Email gives you a trail that you can, if it's by phone, you don't get a trail that request occurred. With an email, at least you have a trail that you made your request. So you need to make that request, and then they have to reject you, that they cannot provide an apprentice for you, and then you've made your good faith effort. The taxpayer must maintain sufficient books and records establishing the request for an apprentice from a registered program, and you also have to have records that show the program's denial of such request or prove that there was a non-response to such request. And I'm not sure how much time you have to wait. All these things will get defined, but either you have to receive a response or you have to wait a period of time to meet this good faith effort. And if you do, then you don't have to have apprentices on the project. So maybe I'll stop there to see if there's any more questions that came up. If you place order contracts for material or labor for the job by 1/28 that are 10% of the job, will it qualify? The mere placing of the order doesn't qualify. You have to actually expend at least 5% of the project cost. Does this stack on top of IRA? Is this from the IRA? I'm not exactly sure what you mean by that question. So 179D, the changes in 2023 were related to the Inflation Reduction Act and certain projects, and you'll see this later in our presentation, certain types of projects can qualify for both 179D and the tax credits created by the Inflation Reduction Act. And we'll highlight that later in the presentation. Methods to qualify for EPAct 179D in 2023 and beyond. So the first way is that whole building energy simulation modeling. Model must be done using IRS-approved software, must look at lighting, HVAC, and envelope specs combined. So you need all the elements of the building, even if you didn't touch them. So if you did just the lighting, you need the HVAC and the envelope in order to run this energy simulation model. The overall building energy usage must be at least 25% more efficient than the ASHRAE standard. And as I mentioned before, all the way out to 2026, the ASHRAE standard is ASHRAE 2007. To get the most deduction, you need a 50% improvement. The other way to qualify is that retrofit only way. It's an alternative method just for retrofits. Retrofits can qualify using energy use intensity. It's kind of like how they use it in Portfolio Manager. We don't know that. Our guess is you're going to get to use Portfolio Manager, but there might be other tools you're allowed to use. Basically, you're comparing your pre-energy use, pre-project energy use to post-project energy use. And that's where you have to show that 25 to 50% improvement. There's no need for an energy simulation model. You can just do it off the EUI. There is going to be a delay because it does take a year's worth of energy data in order to calculate the EUI post-project. So if you finish your project, you're not going to be able to calculate post-project for 12 months at minimum. It will delay your tax deduction. More than likely, it'll delay it 1 tax year before you can take it. We're not really sure how IRS is going to deal with that. And I reiterate this again, starting for projects placed in service in 2023, no more individual system deductions are allowed. So you used to be able to qualify just for lighting, just for HVAC, just for envelope. That's old school. That's only for projects placed in service before 2022 and before. 2023 and after, there's no individual system deductions. It's more holistic. The whole building has to be 25% better than the ASHRAE standard to get the minimum tax deduction. What kind of data do we need? So this is really important. I know we have some lighting installers, lighting vendors on the call. We used to be able to deal with just lighting information. That's no longer the case. We have to run a whole building energy simulation model. So in order to qualify, we need things like the COM check. We need the building plans, architectural, electrical, mechanical, plumbing. We need the lighting information, but we also need all the mechanical information and all the envelope information. So we need all that extra information, even if you just did a lighting project. I can't emphasize this enough. If you're out there doing a lighting project on a building, and you want to go after this tax deduction and you want to go after it through the modeling method, we need you to collect information on the HVAC and the envelope. Ideally, that's in drawings, architectural, electrical, mechanical, plumbing. But there are some workarounds, but we do need full information. There's no methodology anymore to just get it with the lighting information. I can't emphasize that enough. For retrofits, we're going to look for energy bills, and that means lighting, that means electrical and gas, and steam and chilled water, if those are part of your energy bills. We need those 24 months pre-project and 12 months post-project, and then all the bills while construction is happening. So 24 months before, 12 months after, and then all the months in between. That's the way you calculate EUI. You calculate it using information about the building's energy use, and you get that from the energy bills. So that's only for retrofits. Only retrofits can qualify the EUI. New construction obviously doesn't have 24 months of pre-project information. Only a retrofit would have that type of information. So if we're going the EUI method, we need a lot of electric and gas bills in order to do the calculations. So some of the workarounds, for building envelope, exterior shots of windows, and I'm not saying this is a full list. I'm just giving you examples. Interior shots on how the rooms are used, information on the windows, if they're single pane or double pane, highlights of the insulation. You got to go in the attic. I need a depth of attic insulation. I need how thick the insulation is in the walls. Sometimes in the basement, you can kind of see what the insulation level is. You might have to drill holes in the walls in order to get an insulation value. We need information on the roof, on its reflectivity. Unfortunately, there's a lot of information that's required on the envelope in order for us to model those buildings. On the mechanical HVAC side, take pictures of the make and model of the pieces of equipment, or write down the make and model of all the pieces of equipment, and note it on the photos if you're making them. We need to understand what the zones of the building, what air handler reaches what zones. We need documentation on the RTUs, the fan coils, the unit ventilators, the VAV boxes, air handlers, heat pumps, PTACs, boilers, chillers, cooling towers, pumps, condensing units. Every element of the HVAC system, we need make and model information for in order to run an energy simulation model for that building. Lighting, we need a good takeoff, and then we need, to know what lighting is in which rooms, how many fixtures, what's the type of fixtures, are there switches, are there sensors? We need that type of lighting information. So let's see if there's some questions. Without wage rates, without prevailing wage, is the 50 cents to $1 still? Yes. So if you don't meet the prevailing wage and apprenticeship requirement, then de facto you're in the 50 cents to $1 range for the tax deduction. Who is peer reviewing the energy model? How do they know I've modeled it correctly? So there's the chance of audit. So you could be audited by the IRS and then they would review it. But once again, that document is certified, and that certification is done under penalties of perjury. So the modeler themselves is signing a document that says that their model is correct under penalties of perjury. So it's pretty high level of guarantee that the modeler is doing when they model those projects. And then there's the chance of audit, and chance of audit, IRS can review it, and they would have to agree with your modeling. So quick comparison, pre-2023, and we maxed out at $1.88. Now we max out at $5. You used to be able to do individual systems. Now you can only do it on a whole building basis. Designers only got the benefit for designing government buildings. Now the only party that can get these tax deductions for government, not-for-profit, and tribal is the designer. So the only party that can get it for not-for-profits and tribal is the designer, and the same is true for government. It used to be a maximum deduction of $1.88 for the life of the building. Now that's reset every 3 years for commercial and every 4 years for government and tax exempt. In the pre-2023, there was no prevailing wage requirement and apprenticeship requirement. Now, to get the highest level of deduction, you have to meet the prevailing wage and apprenticeship requirement. If you want the lower 50 cents to $1, you don't have to meet prevailing wage and apprenticeship. You must be ASHRAE 90.1 2007. That's still true, but if you're doing retrofits, you can compare the EUI for prior state of the building. You can compare prior state to future state. So just to reiterate where 179D works, for designers of government and tax exempt buildings, it doesn't matter if it's new construction or retrofit, designer gets the 179D benefit. For residential greater than 3 stories, new construction and retrofit are great. The building owner gets those deductions for 3 stories and above. Above 3 stories, sorry, 4 stories and above, new construction and retrofit. But for commercial, only new construction is really relevant. Retrofit really should be using that QIP, should be using bonus, should be using repair reg, should be using 179, which is different than 179D. So commercial is new construction only. If you're doing a retrofit on commercial, then you really should be using those other ways to accelerate the deduction. There's no way to double dip. You can't take 179D and do QIP. It's one or the other. And I would tell you that QIP and repair reg and bonus and 179 doesn't require paying us a lot of money. Your accountants can do all that for those commercial projects. So let's see if there's any more questions. That ends the 179D portion. It doesn't look like there's any more questions on 179D. So I am going to touch upon the Inflation Reduction Act and the new tax credits that were created by the Inflation Reduction Act. So this is a exhausted list of the ITC, the investment tax credit technologies, the Section 48 technologies that qualify for these new credits that were created by the Inflation Reduction Act. You'll notice that there are 3 in bold: ground source heat pump, CHP, and thermal storage. Those technologies, those 3 technologies can qualify for both the alternative energy credit and can qualify your building for the 179D tax deduction. So you can kind of double dip for those 3 technologies. There is a base credit similar to how 179D had 50 cents to $1. The base credit is typically 6%, although microturbines is only got 2%. But all the other technologies got a 6% base credit. And it's only under certain circumstances do you get higher levels of credit. There's one called the 5-time bonus credit. There's one, the domestic content, energy community, low income. And so for technologies like ground source heat pump, CHP, and thermal storage, you can max out at a 50% credit. 50% credit is doable. For solar and small wind, they have this other low income credit, and that can max out at 70%. Please note, some of these bonuses only come about for placed in service in 2023. So domestic content, energy community, and low income only come about if you place the project in service in 2023. Other ones come, the 5-time bonus comes into effect in 2022. So your past projects that you've already completed can get the 5-time bonus, but they cannot get these other bonuses. Those are all for the projects placed in service in 2023. So one of the more interesting aspects of the Inflation Reduction Act is this Section 6417. This is for projects placed in service in 2023 and beyond. And so for some government and not-for-profits, those entities can directly get these same tax credits. This whole list of tax credits, the not-for-profits and some governments can directly get as a direct payment. Incredible legislation for not-for-profits and for some governments. And when I say some governments, it's state or local governments. It is not federal. Federal is left off the table. But if you're doing a project on a state or local government, or you are a state or local government, you can directly get this tax credit as a direct payment to you after your project's placed in service. The other thing that's of interest is the transferability, 6418. If you're not a not-for-profit or state, if you're a tax-paying entity, and for some reason you don't have enough tax liability, you have the ability to sell your tax credit to another taxpayer. State and local and not-for-profits cannot sell their credits, but tax-paying commercial entities can sell their tax credits, once again, for placed in service 2023 and beyond. So 2 different interesting codes, one 6417, the other 6418, and they give some unique opportunities that were just created for the Inflation Reduction Act. Got a couple questions here. Let's take a look. Can you please explain again how the ground source heat pump credits stack and exactly which credits stack? We'll touch on that in the next couple slides. If we have just lighting project, should we make energy model for HVAC building envelope to be qualified in 2023? If you somehow place your lighting project in service in 2022, you should probably take your deduction in 2022 if you don't have this HVAC and envelope information. These new IRA tax credits available for not-for-profits, not for the designer, correct? Yes, that is correct. So 179D, for not-for-profits, the designer was the only person to get the benefit. For these alternative energy credits, the not-for-profit itself is the only party that can get these credits. There is no designer credit transfer. It's just the not-for-profit can get it, or the state or municipal government. They directly get this. It's not for the designer. For the designer, it's for 179D, that other incentive we were talking about. So let's talk about these bonuses. So the first bonus is the 5-time bonus. So you start with your base credit of 6%, multiply it by 5, then that gets you up to a 30% credit. So there are 3 different ways to qualify. The first way is if your project's net output is less than 1 megawatt. So for solar and CHP, that 1 megawatt is kind of easy to understand. That's the nameplate of the thing that you're installing. For ground source heat pump, a little more confusing. We think it's about 284 tons. IRS might come out with guidance that defines it differently, but we think you're safe at 284 tons or less. So you get the 5-time bonus if you're 1 megawatt or less, or we think 284 tons or less. You meet the prevailing wage and apprenticeship requirement. So if you meet the prevailing wage and apprenticeship requirement, you get the 5-time bonus. The last way to qualify for the 5-time bonus is if you started your project, and the definition of start is back to that other definition, the 5% safe harbor and the significant activity at the site safe harbor. If you meet those prior to January 29th, you also get you're also getting that 5-time bonus. You're grandfathered in. So those are the 3 different ways that you can get the 5-time bonus. Your 6% turns into 30%. And that all is for projects 2022 going forward. You can then stack the domestic content or what we call the Made in the USA bonus. So if 40% of the cost of steel, iron, or manufactured product is produced in the US, and we know that IRS is going to provide a lot more guidance on this, but they haven't as of yet, you get the 2% bonus, but that if you meet the 5-time bonus, 2 times 5 is 10, so you get a 10% bonus. So it's either a 2% bonus, or if you meet this 5-time bonus, 5 times 2 is 10. So now your 30% turns into 40% if you meet the domestic content. And what I would tell you is for combined heat and power, and for thermal storage, and for ground source heat pump, a lot of the manufacturers are manufactured here in the United States. And so if you meet this 5-time bonus, those projects, thermal storage, for example, thermal storage had no tax credit before the Inflation Reduction Act. And now a lot of thermal storage can qualify for a 40% credit. So if you could sell thermal storage with a 0% credit, imagine how much thermal storage you could sell with a 40% credit. Once again, stackable. The Energy Community Bonus 2023, there's 5 different ways for you to be considered an energy community. So if your census tract or adjoining census tract with a coal mine closed since 2000, if your census tract or adjoining census tract with a coal-fired plant closed since 2010, if you're on a brownfield site, if your area is 0.17% direct employment related to coal, oil, or natural gas, and you're at higher than average unemployment, or if your area is 25% of its tax revenue for coal, or oil, or natural gas. Sometimes I call this energy community bonus the Joe Manchin credit. But once again, it's a 10% credit. It's a 2% credit, but if you meet the 5-time bonus, that makes it 10%. So you could make that 30% into 40 and that 40 into 50 if you meet the domestic as well. They did create, there's an outside organization that did create a website. I'm just going to switch over to that website for a second. This is a map of not every energy community category, but most of the energy community. So the coal category, the coal-fired plant category, and even the 0.17 employment and higher than average unemployment. So this is the map of the country, and I'm not vouching for the authenticity of this website, but I've tested it with a couple ones that I knew should qualify, and it was mapped correctly. So if you're, and by the way, you can zoom in, like, you can zoom in to any part of this. And so if you're doing a project in one of these areas, you qualify for the energy community bonus, and you get that 2%. And if you're at the 5-time, you get the 10%. So if and why do I call it the Joe Manchin bonus? Well, West Virginia is under this pile of qualification areas right over here. Most of West Virginia is in the energy community, realm. You'll see a lot of Texas is in the energy community realm as well. So if you happen to, but there's also other places. So like you zoom in over here, if you happen to be doing a project right here, that project will qualify for the energy community. Where if you're on this map, you get the energy community bonus. So I'm going to switch back to the presentation. That link is right here. So if you request these slides, you'll get this link and you can go there. SEIA also did a site as well that covers some of this. There's also information on how things are calculated. So if you want the raw data, you can get it at these sites over here. If you want a map of the brownfields, which is not on this website, you can go over here for that information. This is a list of all the counties. Now, county and census tract are not identical, but these are all the counties where a coal-fired power plant has closed. So, and they're in state order. So I'm not saying you are guaranteed to get the energy community, but the map is probably a better tool. But if you're in one of these counties, there's a good shot you might get qualified for the energy community. And then here's where coal mines have closed, Kentucky, West Virginia, Pennsylvania, Virginia. There's how many coal mines have closed in those areas. And if you want the details, you can go to that website. Solar and wind have this other benefit, the low income. That's why solar and wind can go all the way up to 20%. There's another website that was created. I'm not vouching for its accuracy, but it's for low income bonus. So a low income community is a community that is 20% of its population is below the poverty line, or Indian lands get a 10% bonus. Now, if you do, let's say you're in an office building in a low income community, you get this 10% bonus. So you don't have to be residential. You can be any building type in a low income community or on Indian lands, and you'll get this 10% bonus. That bonus is just for 2023 and 2024 projects. The way to get the 20% is if you're a qualified low-income residential building, and there's going to be all sorts of requirements on how you become a qualified low-income residential building, or if it's a qualified low-income economic benefit project, and there'll be all sorts of requirements for that. Though that guidance will come out hopefully shortly. But then you get a 20% bonus instead of a 10% bonus. Once again, if you want a copy of these slides, jacob.goldman@energytaxsavers.com. We'll briefly talk about the three technologies that get both 179D and these tax credits. So for the tax credit, ground source heat pump, what typically qualifies? That's the bore field and the heat pump. It's upstream, it's the heat pump and upstream of the heat pump. For anything downstream of the heat pump, that is a tax interpretation. There is no guidance. It is a tax interpretation. That tax interpretation is related to this section of code, section 1.48-9C10(4). That section of code is what defines the tax interpretation. But you are taking an interpretation. There's nothing that says this is the rule. It's an interpretation of other laws that we're using. And basically what it's saying is if downstream, if your ductwork, if your pipes, if your diffusers, for example, if the energy going through them is more than 75% coming from the ground, then that equipment is eligible for this tax credit. If, for example, you have a backup boiler and the backup boiler runs through those same items, obviously the backup boiler doesn't qualify for the credit. And then if the backup boiler on an annual basis provides more than 25% of the energy, let's say it provides 26% of the annual energy that runs through the ductwork, then you cannot take the ductwork at all as tax credit eligible. Ground source heat pump has laws all the way out to 1/135. So you'll be able to get these tax credits all the way out to 1/135. The efficiency of a large ground source heat pump project is going to get you the 179D. That building is going to be energy efficient enough to get 179D as well. So that's why you can stack those. Thermal storage. Thermal storage is, typically you're making ice during the night and using the ice to cool the building during the day. It has to be directly connected to the heating, ventilation, or air conditioning system. It has to remove heat or add heat to a storage medium, and it needs to provide energy for heating or cooling of interior of residential or commercial buildings. So let me note there, it has to be building related. So if you're using thermal storage for a process, that thermal storage doesn't qualify for this tax credit. You have to be using it for a building for it to qualify for this tax credit. And that incentive is around for 2 years for projects construction beginning before 1/1/2025. We're hopeful that it'll get extended after that, but there's no guarantee on that. CHP is, has to start before construction before 1/1/25. The key aspects is if your CHP project is bigger than 50 megawatts, no tax credit at all. If it's smaller than 50, but bigger than 15, there's a haircut. Let's say your project was 30 megawatts. You cut your credit by half. 15 divided by 30 cuts your project in half. And the CHP has to have 20% of its useful energy from thermal, 20% of its useful energy from electrical or mechanical. And it has to be 60% efficient. And here's where it's interesting. For CHP, it does not include property where you transport the energy source to the facility or distribute energy produced by the facility. So things like transformers downline of the CHP, or things like, things for delivering the gas, for example, to the CHP system, that equipment and that design and that install does not qualify. So that ends the presentation. I'm going to go look at the chat, but if you want copies of the presentation, jacob.golden@energytaxsavers.com. We are recording this. We're going to post that recording. And if you'd like to know where it's posted, you can send us an email and we gladly send you the location of that recording. I think I'm recording. If I'm not, then I'm going to have to record the next section of this. Let's just go into the chat and get these last questions. Can EV charging stations included? There are tax incentives for EV charging stations. They're not Section 48, which was the ITC credits that we talked about here, but there are some tax credits for EV, but they're not part of this this discussion. But there are some tax credits there. And Tom, thank you for your comments. Can you stack thermal storage credits with ground source heat pump credits on the same project? Yes. The thermal storage project will get its own credit. The ground source heat project will get its own credit. Equipment that is neither thermal storage or ground source heat pump, no credit for that equipment. So yes. What's light and dark blue areas on the map? I don't know for sure, but I think the dark blue were areas that met the 0.17% employment from coal, natural gas, and oil, and higher than average unemployment. And the other areas were the coal-fired plant, the census tracts where there were coal-fired plant or closed coal mines. So I think that answers that. And I think I answered that one already. Let's see if there's anything else. Thank you. So with that, I'm going to stop the recording. And I thank you all. If you want copies of these slides, if you want the link to the presentation, shoot us an email and we'll send that to you. We'll probably put it up on our website somewhere as a possibility, but it also would be on our YouTube channel. So if you search for the Energy Tax Savers YouTube channel, that would be another location that you could find it. And I'm going to stop the recording here.